Okay, so we've got David, we've got Benedict, we've got Farik. Let me know where you're from, guys. And see how far you are. Singapore, Argentina, we've got from England, Melbourne, New York, KL, Penang, California, Philippines, Sydney, Denmark, Shanghai. Oh, you managed to get through the firewall. That's good. Brisbane, and Florida, and Toronto, and Miami, and Houston. Okay, wonderful. Good to see all of you. Again, welcome to the 7th webinar in this black market event. And of course, this is the 9th black market event that we're running for the 9th year. And black market is our biggest event for the year and the biggest sale for the year, as you guys know, where if you're interested to get our investing and trading courses and subscription playbooks, you get the highest discounts during this very short period of time. So I know that you've been waiting a long time for this and a lot of you grabbing deals. Take advantage of all these great deals, right? Great. So I do hope that you have caught the previous 6 webinars. Have you guys been watching the webinars for the last few days? Has it been useful? Has it been insightful? Yeah, great. And again, if you missed any of the webinars, no worries. You'll be sent the replay link shortly if you have not already received the replay link, right? So what has been covered? So if you recall my first webinar, I talked about how do you compound your wealth, how do you build generational wealth by investing in the highest quality stocks, the top 1% of stocks when they're undervalued. And that approach, I get at least 20% return a year consistently over the long run. I've got many students I showed you that have got much higher returns because they're a bit more aggressive. So that was the first thing, right? Then you also attended webinars by Alison Chu, where Alison focused more on short-term trading in stocks, in futures, in cryptocurrencies, which is more short-term trading, not so much long-term investing. When he talked about how he uses price action based on price action manipulation in the markets, understanding how market makers induce retail traders to panic and sell at the bottom and to get too excited and buy at the top, and how do you understand these manipulation patterns, how do you trade alongside these patterns to generate profits in the short term, right? Then you heard from myself, you heard from Bang on options trading, where you learn how you can use options to turbocharge your long-term investments, as well as using options to trade without having to be right on the direction too much, right? How to be a net option seller than option buyer, and how you can actually have very high win rates of 70, 80, 90% trading options because it gives you a very wide profit zone. And options also gives you a lot more flexibility, as you've learned, where there are many different option strategies, in fact 26 that we use, where you can profit whether the market is very bullish, going up, or going sideways, or going down, whether it's high volatility or low volatility. All right, so you've learned that there are so many ways to create wealth in the markets. There are so many ways to generate income in the markets. All right, and you choose the one that resonates the most with you. Choose the one that you think you enjoy doing. Okay. Now, so for today's session, I'm going to focus on something that is very different. So today, my focus is on teaching you about income investing. Income investing, where we invest in income assets to generate monthly or quarterly cash payouts. Okay. And out of curiosity, how many of you have already been investing in income assets? For example, like dividend stocks, and for the purpose of getting regular cash payouts. How many of you have already been doing that? Okay, great. So I believe that you're here because you want to learn how to do that better, how to get higher yields from your income assets. Yeah. How many of you have never invested in income assets or dividend stocks, but you want to start to build a income portfolio so that eventually you can retire financially free and just work for fun? Okay, great. So you've come to the right place, right? So let me ask you this question. What is the main difference between income investing and what you've learned so far, like options trading and stock trading and all that? Because they all create income, right? They all create income. But what do you think is the main difference? George, very good, George. Yeah. Fiong Wen also giving the right answer. Many of you. Wei Yang, correct. So the main difference is income investing is 100% passive investing. Please write this down. It's 100% passive investing. So what does passive mean? Passive means that once you buy the income assets, you don't need to do anything anymore. You sit back and you just let the income asset pay you cash every month or every quarter. It's totally passive, correct? Whereas the other approaches where you learn options trading and swing trading, all that is more of an active approach where you have to actively trade the markets. You have to look for trades, set up, right? You have to buy, you got to sell, you got to put a stop loss for trading, you got a profit target, right? So it's more active. Whereas income investing is purely passive. Is that clear, everyone? Okay. So ultimately, how many of you want to reach a stage where all your income is totally passive? That means you make the money whether or not you press the button. You make the money whether or not you wake up in the morning. I think that's the ultimate aim. Okay, great. So I'm going to show you how to do that, because remember that ultimately, what is financial freedom? People all say I want to be financially free, but the definition is you're financially free when your passive income. So again, passive income is income you earn without spending your time to make that income. It's income you earn without exchanging your time for money, right? It's income you earn whether you wake up in the morning or not, right? So when your passive income exceeds your expenses, that's when you're financially free. Yeah, so we're going to focus on the best way to build these kind of assets. Cool. Okay, great. Now, as you guys know, I've shared with you in my previous webinars, I've got several portfolios, okay? So I've got my capital gains portfolio, which I showed you in my last webinars. I've got 2 capital gains portfolio, and the main objective of that is to grow my wealth at 20% returns or more a year, right? So that is more of building wealth, okay? Now, I also have got an income portfolio where the main objective is not to build my wealth that much, okay? But the main objective is to get regular cash payouts, is to get things like dividends and interest, all right? And at the same time, as you guys know, I also trade options. I also trade stocks once in a while, right? So people say, why do you do everything? Because I use what we call a barbell strategy. This is called a barbell strategy. And the barbell strategy is one where I balance between growing my wealth and getting regular dividends. It's a barbell strategy, okay? So again, for building my wealth, I've got my capital gains portfolio where I invest in growth assets, which I showed you, right? So in full transparency, let me show you again for those of you who have missed the previous webinars. These are my growth portfolios. I've got 2 of them, right? Let me just remove that, right? So what kind of stocks do I own? I own stocks that don't really pay any dividends, but they grow at high rates, right? So growth companies like Amazon, Nvidia, Alphabet, Meta, Palantir. I've got healthcare, so like United Health, Broadcom, Mercado Libre, Palo Alto, ServiceNow, Booking.com, okay? And this is the other one, which actually they're both the same. It's just that I put them under different accounts. One is more of a joint account with my wife, the other one's under my company account, right? So again, it's basically similar stocks, okay? So again, notice that these stocks that I buy for my capital gains portfolio, they grow my wealth significantly. They compound over 20% on average every single year. Okay, but they don't pay much dividends at all. So there's no cash I can collect. It's just to build my wealth. You get the point, right? So Again, my capital gains portfolio, you can see I've showed you in full transparency, in the last 7 years, it has grown 277%. Okay, versus the S&P 500 that has grown 171%. So if you do a compounded annualized return, that's about 21.74% per year. That's my capital gain portfolio. Okay. Now, for my income portfolio, my dividend portfolio, do you think I can grow it at 20% a year as well? Do you think I can grow this at 20% a year as well? No, I can't. Okay, no matter what I do, I can't, because these assets, they don't grow at 20% per year. Okay. So what are income assets? I'll go into detail in a while, but they include dividend stocks, they include private credit, they include REITs as well as bonds. Okay. So my income assets, again, they don't grow at over 20% a year, but they grow roughly about half of that. They grow about 11, 12% a year. But more than half of that growth comes from cash payouts, cash dividends, right? So again, in full transparency, I'll just show you. I hold my dividend portfolio under my bank, DBS Bank, and you can see that year-to-date return is 9.2%, right? From January to November, this is 9.2%. So it's not super high growth, right? It grows about 11, 12% a year. So far, 9.2%. By the end of this year, this should be about 11, 12%, which is what I get on average every single year. You can see that the cash flow is significant, which I'm going to show you in a short while. Okay, and what kind of stocks do I hold? Right, I hold many dividend stocks. So I hold like OCBC, I hold UOB Bank, I hold REITs like Capital Integrated Commercial Trust, Fraser Centrepoint Trust, Capital Ascenders REIT, Parkway Life REIT, right? So these kind of stocks are what we call dividend stocks. They are called income assets. You know, they don't grow 20%, they grow 10, 12%, but they pay very high dividends very regularly, right? So that is the income assets. Now, at the same time, I also trade options. Okay, those of you who are in my UIP, you can see that I trade options almost every day, right? Where I sell cash to put options, I sell credit spreads to earn income as well, right? Now, but options trading is active income because I have to actively trade options, right? So this active income is purely passive, and these two generate the cash flow that I get. So this cash flow is used to pay my expenses. At the same time, the cash flow, I use it to also invest into the growth assets that build my wealth. So it's a complete flywheel, right? They all kind of like build on each other. Make sense? I don't think Australians can buy Singapore shares. Of course you can. You know, anyone in the world, whether you're from the US, Australia, anyone can buy Singapore listed stocks. Of course you can, right? You just have to use the right broker, you know. And one of the reasons why I'm using Interactive Brokers is because Interactive Brokers, which by the way, they have an Australian office as well, right? Interactive Brokers allows you to buy stocks from over 160 stock exchanges around the world, right? So Interactive Brokers, I can buy and sell Australian stocks, US, UK, Hong Kong, you know, everywhere in the world, right? So that's why I like to use Interactive Brokers. I'm not promoting them. I don't get any commissions from them. I'm just telling you that they allow you to access the most markets in the world, right? So yeah, definitely you can. And if you're wondering, if you don't know, right, Singapore is a tax haven. So Singapore has got zero capital gains tax and zero dividends tax. So even if you're a foreigner from Australia, US, UK, you buy Singapore listed stocks and REITs, zero capital gains tax, zero dividends tax. But of course, you may have to pay tax to your own government, but not to the Singapore government, right? So that's pretty cool. Okay. Can I use IB to buy Singapore stocks? Yes, you can as well. You can as well. No problem with that. Okay. As you guys know, you attended my options trading webinar. And for options trading, you know, I also generate a pretty good consistent profit every single year, even during the bear markets, right? So I do everything, right? I've got my growth investing, my dividend investing, my options trading, because ever since I was young, I wanted to create what I call multiple streams of income, multiple sources of income. Now, must you do everything like me? No. You don't have to. It's up to you. Some of you may just say, Adam, I just want to do options trading. That's fine. You know, Adam, I just want to do dividend investing. That's fine. Adam, I want to do everything like you. That's also fine, right? So there's no right or wrong, okay? Now, a common question people ask would be, you know, what percentage allocation do you give to your growth investing and your dividend investing? Now, there's no right or wrong. There's no right or wrong, right? But roughly for myself, let me just look at the figures I wrote down, okay? Roughly for myself, about only 10% of my portfolio is in trading. So, right, only 10% is in trading. About 60% is in growth investing. My capital gains portfolio is 60%. And then the remaining 30% is in the income investing. So that is my allocation. But again, there's no right or wrong. That's my preference. If you look at someone like Elson, okay? Elson, what percentage of his wealth is in trading? What percentage of Elson's wealth is in trading? Anyone make a guess? Yeah, it's like 70, 80%, right? So Elson doesn't hold any stock investments. From what I know, he has got zero investments in stocks. From what I know, he has got zero income dividend stocks. From what I know, right? So for him, it's 80% into trading because that's his preference. And the other 20% is real estate. Some of you may know that he bought 2 shop houses during the COVID crash when they were very cheap. He was so lucky he bought this, one of the shop house he bought at, I think, $3 million in Singapore. It's a shop house in Joo Chiat, right? Or was it Race Course or something like that? And now that is now worth, what, $7, $8, $9 million, right? So that's it. Now, how about Bang Fan Fan? Bang Fan Fan is also totally different, right? So Bang also doesn't invest in any stocks at all. He doesn't have any bonds or any REITs, from what I know. Okay, so Bang, same thing. Bang is 80% into options trading. 80% into options trading. How about the other 20%? What does he do with the other 20%? You guys know? I don't know what he told you. Bang owns, I think, about 12 apartments in Vietnam, and they're all rented out collecting rent for him. Okay, so we all have our own way of creating income. Okay, and there's no right or wrong. There's no right or wrong. We are showing you different approaches, and you choose what you think works best for you. Okay, great. So let's now focus on today's topic, where today, again, I'm going to focus on how I build my income asset portfolio. Okay, that is my focus today. And again, if you have questions, feel free to ask in the Q&A tab. I'll do my best to answer as many questions as I can in the Q&A session at the end of the webinar. So stick all the way to the end for the Q&A session. All right, where we'll do that. Okay, great. So there are 4 main income assets that I invest in. Now, of course, there are others, but these are the 4 that I focus on. Right, so I'm going to focus on it. So what's the first income asset? The first income asset is dividend stocks. Okay, dividend stocks. Now, again, what is a stock? When you buy a share of stock, what are you buying? Are you buying a lottery ticket? Are you buying a ticker that just goes up and down every day? No, right? So remember, when you buy a stock, you're buying a business. Okay? So essentially, when you buy dividend stocks, you're buying an ownership, a part of a business that's very profitable, that generates consistent profits, and they pay you a part of their profits as cash dividends. Okay? So I like to use the word business instead of stocks. Right? So this first thing is called business dividends, which are basically dividend stocks. Now, the other thing I want to focus on is this term called starting yield. Can you see this thing called starting yield? Okay. Now, what is yield? Yield is basically how much cash you get. So the cash in this case is dividends, right? Is the dividends per share, DPS, dividends per share, divide by the price of the share or the asset. Okay. Make sense? Okay. Now, if you buy dividend stocks, what kind of starting yield should you get? Okay. Between 3% to 6%. That is the normal starting yield. Now, of course, you have those which are much higher, but most of them are between 3 to 6%. Now, bear in mind, I'm only talking about high quality stocks, not low quality. I only buy very high quality stocks, the top 1% in the world. Okay. Now, when it comes to dividend stocks, I mainly focus on Singapore listed stocks and not the US. Okay, I never buy US stocks for dividends. I never buy US stocks for dividends. Anyone would like to guess why? Because number one, US stocks, they pay very little dividends. Okay, in fact, most US stocks, even the high dividend paying ones, they only pay 3% at the most. And if I buy US stocks, there's a 30% withholding tax on the dividend. So after I get taxed, what I get left is only 2%, which is a very waste of time. Right? So when I buy US stocks, it's never for dividends. US stocks is for growth, to grow my wealth. Okay. Whereas if you look at non-US stocks like Singapore, like Hong Kong or UK, for example, the yields are much higher, right? The yields are usually about 5 to 6% yields, and it's tax-free. Understand? Okay. So again, I'll talk more about this in detail in a while. But that's the first thing, dividend stocks. The second income asset that I invest in are REITs. So what are REITs? REITs stand for Real Estate Investment Trust. Now, someone said Pfizer pays a lot of dividends. Well, first of all, I don't think Pfizer is a high-quality company. Number one. Number two, I tend to avoid pharmaceutical stocks because their profits are very inconsistent. Okay, their profits are very inconsistent. So I tend to avoid pharmaceutical stocks. Okay, so what are REITs? REITs are Real Estate Investment Trust. So basically, when you buy a REIT, you are buying a portfolio of properties. Okay, so you're buying basically real estate. You're buying real estate, and you're getting part of the rentals of the real estate, right? So basically, it's real estate rentals. Now, starting yield for REITs is between 5 to 7%. Again, bear in mind, we have to talk about this thing of starting yield. Now, same thing. You've got US listed REITs, you got Malaysian listed REITs, you got Hong Kong listed REITs, you got Singapore listed REITs, and for REITs, same thing. I don't tend to buy US listed REITs, although there's some good ones, but I tend not to buy US listed. Why? Anyone knows why? Again, because same reason, withholding tax of 30% after they tax me, I've got nothing left. Right? Number two, US listed REITs also have relatively low starting yields, and they tend to have higher gearing ratios. What's a gearing ratio? Gearing ratio is the debt ratio, which is the total debt divided by total assets. So to me, I feel a bit uncomfortable because I think that their debt levels are a bit high. I prefer Singapore listed REITs because again, their debt to asset ratios are lower, the yields are higher, and it's tax free. Okay. Now, for those of you who are Singaporeans, one thing to be proud about: Singapore stock market is one of the biggest REIT markets in the world. Okay, we are well known for REITs, in fact. Right? Okay. So for this one, again, I tend to focus on Singapore stocks. This one, same thing, Singapore listed as well. Now, again, if you want to buy US listed REITs, you can, nothing wrong. And you want to buy US listed stocks, you can as well. And in fact, in the income investing course, I show you how to find the best US listed REITs and stocks. And if you're not affected by the 30% withholding tax, then by all means, you can go buy that. Right? I'm not saying that you shouldn't. Yeah. Okay. The next thing that I invest in are bonds. I invest in bonds. Now, both corporate bonds as well as government bonds. Now, what's a bond? Yeah, correct. UK is tax free as well. UK stocks, the dividends are tax free. That's correct. Yeah. Farid is mentioning that. Okay. So when you buy a bond, when you buy a government bond, you're lending money to the government, and they pay you a fixed interest. Okay. If you buy a corporate bond, you're lending money to a company, and they pay you a fixed interest. So those are bonds. Yeah. Now, so for bonds, basically, you are lending money to get interest. You're getting interest income from bonds. And the starting yield for bonds is between 4 to 6%. Of course, depending on the currency, whether it's a Singapore dollar bond, or it's a US bond, or it's a Euro bond, right? But generally, that is a range of bonds. Okay. The next thing I invest in is private credit. Okay. Now, private credit has the highest starting yield. Now, again, bear in mind that I'm only talking about high quality private credit, not low quality. I only buy the highest quality, which are the safest ones. Okay. So for private credit, the starting yield is between 8 to 10%. Now, for those of you who have no idea what's private credit, I'll talk about it. Sorry. For those of you who have no idea what's private credit, sorry, give me a second. Yeah, I'll talk about it more later on. Okay. But in a nutshell, private credit is basically direct lending. Okay. It's direct lending. Yeah. Now, any questions at this stage? Let me see. Any questions? Lean is asking, says, Adam, I have read about the dangers of private credit, bubble, blah, blah, blah. Okay. So, like I said, in any market, there are low quality bubbles. Okay, like you say, oh, the stock market is a bubble. Yes, correct. Some parts are bubble, which I've talked about, right? I don't touch those parts. I touch stocks that are highest quality, that are undervalued. Same thing with private credit. Is there a lot of lousy private credit? Are there private credit in a bubble? Yes, I don't touch those. Okay, I only touch the private credit that is very, 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 very safe to me because I've done my research and that is very attractive. Okay, now again, people like to ask me this question: Adam, private credit, bonds, REITs, dividend stocks, growth stocks, are they risky? Are they risky? Like people ask me, are growth stocks more risky or dividend stocks more risky? Are dividend stocks more risky or are growth stocks more risky? Are bonds more risky or private credit more risky? Is private credit more risky or bonds more risky? What's the answer? The answer is risk does not come from the asset. Okay, write this down, everyone. Risk does not come from the asset. So let me give you an example, right? Could bonds be very, very risky if you don't know what you're doing? Yes. Have you heard of Lehman Brothers? Have you heard of High Flux? A lot of people, they don't understand bonds. They bought Lehman Brothers bonds, they bought High Flux bonds because they were told by their banker it's very safe. And Lehman Brothers and High Flux collapsed, the bonds went to zero. They went to zero. Understand? Okay? So understand that risk comes from not knowing what you're doing. Risk comes from incompetence. If you don't understand options, options is extremely risky. If you understand options well, options can be very, very safe. Same thing with bonds. If you don't understand bonds, they can be very, very risky. If you understand bonds, they can be very safe. Same thing with private credit. If you don't understand private credit, don't touch it. It's very risky. But if you understand private credit the way I understand it, it is very, very safe. So risk comes from incompetence. Something is risky because you don't know what you are doing. It's the same thing. Is driving risky? If you have ever taken driving lessons and you jump into a car, you try to drive down the expressway, of course it's risky. You're gonna get into a bad accident, right? But if you take driving lessons, you know the traffic rules, you follow the traffic rules, then driving becomes relatively safe. And driving gets you to where you want to go a lot faster than people walking or putting their money in a fixed deposit. Does it make sense? So my job today, and my job in all the courses together with Outside the Bank, is to teach you how to become very, very competent in all these investment assets so that it no longer becomes risky to you. Does this make sense, everyone? Okay, so I know some of you are asking questions like, how do you invest in private credit? I'm coming to that in a while, so just hold on, yeah? Okay, now some people ask me, Adam, if private credit gives the highest yields of 8 to 10%, why don't you just invest in private credit? Why do you want to invest in other things? The reason is because of diversification. You need to diversify across the 4 different asset classes. Why? That means in your income portfolio, you need to have some bonds, you need to have some private credit, you need to have some REITs, you need to have some different stocks. Why? Why do you need to diversify? Because they all behave differently under different economic scenarios. They all do better under different economic scenarios. So let me give you an overview here. Oh, by the way, this is my portfolio just to share with you. I did a screenshot as of yesterday. Okay. So my total income collected in a year, this is over 1 year, right, is $431,000. This includes my dividends, as well as the interest I get from my bonds, right, interest from bonds, and from private credit, right? So total is 431,000 in a year. Okay. Now this portfolio here is about 7 million, right? 7 million. So 431K out of 7 million is roughly about 6% yield. So my average yield across my portfolio is about 6%, right? It's about 6%, and it's growing constantly, right? So in my portfolio, roughly 33% of the portfolio are in dividend stocks, 23% are in bonds, 15% in private credit, and 29% in REITs. Now, why is it private credit has got the lowest allocation? Because I only started investing in private credit only about 2 years ago. That's why, right? But recently, most of my new money is buying private credit, especially what happened about 2 months ago. There was a big drop in private credit funds, which I took advantage of, right? In fact, those of you who are in UIP, if you're in the Ultimate Investors Playbook, you get my daily buy and sell notifications. I tell you exactly what I'm buying, what I'm selling in private credit as well. And in the last 2 months, I was able to buy many private credit assets at 13 to 14% yield because they dropped temporarily because of some bad news, and I took advantage. I bought a lot of it, right? So private credit, I only started 2 years ago, right? But my goal in the next few years is to increase this to about 20%, right? About 20%, and then the rest will balance, right? So that is my strategy, okay? What is the high transaction cost of 32,000? Okay, good question, right? So, by the way, I'm buying this through DBS Private Bank, and unfortunately, when you buy through private banks, they charge you a lot of high transaction fees, but they are all one-time fees, okay? So most of the transaction cost comes from me buying bond funds, okay? So when I buy bond funds, because I buy quite a big amount, right? So when I buy bonds and bond funds, the private bank charges a spread on the sale, right? So it's about 32,000 a year, right? But the good thing is that this is fixed. Sorry, this is one time. So once I pay that one-time fee, it no longer happens, right? So it's a one-time entry, you can see, right? Okay, so like I said, why do I invest in all of them? Why do I have a portfolio? Because they all do well under different economic scenarios. Give me a second. Okay. So what do I mean? So as you know that the global economy, they go through periods where interest rates increase, right? So when the interest rates rise aggressively, you recall in 2022, how many of you remember that? In 2022, interest rates went up at the fastest pace in 40 years, right? Now, are interest rates going up or going down? Are interest rates now going up or going down? Yeah, they're now going down, right? Okay. So first of all, when interest rates go up, is it bullish or bearish for dividend stocks? Let's learn this, right? When interest rates go up, is this bullish or bearish for dividend stocks? The answer is it depends on the kind of stock. It depends on the kind of company. So for example, if you buy banks like DBS, UOB, OCBC, which I have, right? When interest rates go up, do the banks make more money or less money? When interest rates go up, the banks make more money, right? Because they can price their loans higher. It increases their net interest margin, okay? So when interest rates rise, it is bullish for banks, okay? However, if you buy a dividend stock like a property developer or a shipping company or an airline like Singapore Airlines, then it is bearish. It is bearish. Why? Because when interest rates go up, what happens to Singapore Airlines? Singapore Airlines has a lot of debt, right? So do a lot of shipping companies have a lot of debt. So interest rates go up, they have to pay more interest on the debt. So when they pay more interest on their debt, their profits go down. When their profits go down, they pay less dividends. You understand? So it depends on the kind of dividend stock. Yeah. So for me, most of my dividend stocks are financial stocks. So they benefit from rising interest rates. Got it? Okay. Now, how about when interest rates fall? Is it good or bad for dividend stocks? Is it good or bad for dividend stocks? Again, it depends on the kind of company, correct, right? So if interest rates fall, then if the company has got debt, like again airlines or shipping companies, they pay less interest on the debt. So their profits go up, they pay more dividends, correct? Yeah. Now, how many of you recall that people were concerned that if interest rates fall, the banks would drop, like DBS would drop, OCBC would drop because their net interest margin, their net interest income would drop? Remember? A lot of people say that, but did that happen? No, right? In fact, DBS is still going up, UOB is still going up, OCBC is still going up, right? Why? Because even though interest rates fall, the banks may earn less in terms of their net interest income, but the number of loans increase. People are taking more loans because of low interest rates, right? And their non-interest income, like their wealth management fees, that goes up, right? So in other words, the good thing about banks, the well-run banks, is that they do well in both interest rate going up and interest rate going down. They will both do well. Understand? The only time they will not do well is if the economy goes into a recession. Then of course they won't do well. But the good thing is the recessions last forever. recessions don't last forever. Recessions at the most last for 6 months or 1 year. That's it, right? So if you're a long-term investor in these dividend stocks, who cares if there's a recession? I don't care. Even if there's a recession, I ride it through, I still get my dividends. And in fact, I use the recession as a chance to buy more at big discounts because they will rebound once the recession is over. Make sense? Okay. Now, however, will I ever buy Singapore Airlines for dividends? Will I buy oil and gas company for dividends? Will I buy property developer for dividends? Will I buy shipping companies for dividends? No. Why? Why would I? Because these companies have high debt. So I avoid companies with high debt because companies with high debt, what happens is when interest rates rise, their profits collapse and their dividends are cut, which I don't want. Okay. And then these companies, their business is very cyclical as well. So their profits are very inconsistent. Yeah? So a lot of this you will learn in greater detail in the income investor course. When I teach in detail what is my criteria for investing in high quality dividend stocks that give very consistent dividend income. Make sense? Okay. Next, let's talk about REITs, real estate investment trust. Now, before that, so again, like I said, for dividend stocks, the starting yield is 3 to 6%. And if you pick the right business, does the dividend grow? Do they increase their dividends over time? Yes or no? Yes, right? So you've got dividend growth. Okay. Now let's talk about REITs, real estate investment trust. Now for REITs, their starting yield is higher than dividend stocks. So 5 to 7% starting yield. And again, if you pick the high quality REITs, do they increase their dividends over time as well? Yes. Okay. Now, when interest rates go up, like in 2022, what happened to REITs? When interest rates go up in 2022, what happened to REITs? Right? Short term, it is bearish, especially when the rates rise rapidly. Okay. But in the long term, even if interest rates stay high, REITs can still do well. Because when rates stay high, in the long term, it means the economy is doing well. And REITs can increase their rental. They can increase their rents. And so that offsets the higher interest rates. Okay. Now interest rates are falling. Do you notice that REITs are now doing well? Do you notice that now interest rates are coming down, REITs are doing well? Yeah. So when interest rates fall, REITs are bullish. Unless we go into a what? Recession. Of course, if you go into recession, nothing does well. Everything goes down, but temporarily. Recessions don't last forever. They last for 6 months to 1 year and it rebound. Okay. So never be afraid of recessions. Never be afraid of recessions because they will come and go. In fact, take advantage of recessions to add more of your income assets at bigger discounts. Now, who are the only people who should be afraid of recessions? Who are the only people who should be afraid of recessions? The only people who should be afraid of recessions are people who hold low quality assets. Because in a recession, the low quality stocks and REITs will drop and never come back. They will never come back because they are low quality, correct? But if you buy high quality, then there's no worries because the drop is always temporary. The other people who also should fear recessions are those who buy on margin. They borrow money to buy. Now, should you ever do that? Never borrow to invest, okay? If you never borrow to invest, then you have no concern over temporary market drops, which will happen from time to time. Okay, next, private credit. Now, how do we invest in private credit? Again, I'll go into detail in a while later, okay? But basically, we invest in private credit using BDCs. What is a BDC? A BDC is called a business development company, which is a special kind of business structure that exists in the US, okay? Only in the US. So I only buy private credit from the US, not Singapore, from the US, okay? So private credit, the starting yield is 8 to 10%, and do they increase their dividends over time? Also, yes. Now, the great thing about private credit is this. When interest rates rise very fast, a lot of dividend stocks go down, except banks, right? When interest rates rise very fast, REITs go down. When interest rates rise very fast, bonds go down. But when interest rates rise very fast, private credit does very well. They do very well. Why does private credit do very well when interest rates rise? Because later I'm going to teach you more. Private credit, they give floating rate loans. The loans are floating rate. So when interest rates are high, they earn much higher profit from their loans, right? Then you may say, but then Adam, now interest rates are falling. Isn't that bad for private credit? Well, it's not bad, but it is neutral. It is neutral now. So now that interest rates are falling, private credit, the share price won't go up as much. It won't go up as much. Okay? But it also won't collapse if you buy the high quality ones. Because when interest rates are falling, people will take more loans to expand their business. So private credit get more business. So it's a win-win situation. Again, unless there's a what? Recession. Recession, of course, it won't do well as well. Right? Nothing does well in a recession. Except one thing. Right? There's only one thing that does well in a recession. There's only one thing that does well in a recession. Out of all this, what is that? Gold. No, gold has no cash flow. Right? We're only interested to buy things that give cash every month, every quarter. Gold doesn't give you any cash. Okay? The only thing that does well in a recession are treasury bonds. Okay? So notice that when interest rates fall, even in a recession, treasury bonds do very well. What are treasury bonds? Treasury bonds are US government bonds. Okay? So I'll come to that later in a while, right? Okay, next would be corporate bonds. Corporate bonds means, again, you buy bonds from companies. Okay, again, not high flux, not Lehman Brothers, those are low quality. You buy high quality corporate bonds. Okay, starting yield 4 to 6%. But the problem with corporate bonds is what? The interest they pay you doesn't grow, right? It doesn't grow, it is fixed coupons. The interest is fixed. Okay? Now, when interest rates rise, bonds drop, as you guys know. In 2021, 2022, 2023, bonds drop because interest rates were going up. Now that interest rates are going down, bonds are going up. Again, unless there's a recession. Recession, this one also die. Short term go down, right? Okay. Government bonds has the lowest yield. Okay, this is the lowest starting yield. Again, no increase in the dividend they pay you. It is fixed coupon. Interest rates go up, very bearish. Interest rates fall, very bullish. Okay, so as you can see that they all have their pros and cons. They all do well in different situations. Okay, so when I buy a portfolio of all these together, what happens? When I buy a portfolio of all these together, what happens? My portfolio is well diversified. So no matter what happens, I don't care. High interest rate, I do well. Low interest rate, I also do well. Okay, so that's the whole idea because no one can predict the economy. Even the top economists can't predict the economy, all right? And no one can predict when is the next recession. All the top economists say, oh, there'll be a recession in 2020, all right? Or rather, they say the recession is going to get worse in 2021. It didn't happen. All the economists say there's going to be a recession in 2023. Didn't happen, right? So I always tell my students, don't waste your time trying to predict the next recession. Because no one can predict. It could happen next year. It could happen in 10 years. Who knows? Who cares? Okay, our job is not to predict the economy. Because, again, no one can do it, right? Our job is to build a bulletproof portfolio that will do well no matter what happens. So that we invest in a stress-free, low-risk way. Does it make sense, everyone? Okay? Okay, very good. So let me go into more detail. So let's take a look at interest rates, okay? Now, you can see that interest rates have already peaked, yeah? So these are the US interest rates. This one here, this is the 5-year interest rate. This is the 10-year. Is it 10-year? Let me just double check. Oh, sorry, 1 year. Okay, my bad. Huh? Okay, sorry. This is the 1-year bond. This is the 5-year bond. Okay, this is the 1 year, 5 year, right? So you can see that it went up very aggressively. The Fed raised rates very aggressively in 2022, 2023. Now, why did they raise rates so aggressively here? Why did they do that? Why did they raise interest rates so aggressively? In order to kill inflation, right? In order to bring down inflation. Now that inflation is more or less under control, they are cutting rates, right? So you can see that it peaked here and now rates are coming down. Can you see that? So now rates are on a downward cycle. Like, how many of you notice that your fixed deposits, your time deposit on your US dollar cash is going down? You notice that? Yeah, of course, right? Because that's happening, okay? Now, how about Singapore interest rates? That has dropped faster and deeper. So you can see that currently, this is the Singapore 1-year bond rate, and this is the Singapore 5-year bond rate. And in 2024, it went as high as 3.8 to 4%. How do you remember the time when you put your money in a fixed deposit in Singapore dollars, you could get over 3%? Remember those good days? Remember those good days? Yeah, it only lasted for 1 year, right? And now it has dropped. Now it's only 1.35%. And in fact, if you put your Singapore dollar time deposit, now you're getting less than 1%, right? Okay. So how do you find that? Shit, now I'm getting so little for my time deposit, I have to find assets that can give me higher yield. Okay, so I get more passive income. How do you want to get that, right? So that's the whole idea, right? So question, and Singapore interest rates have dropped 50 to 65% from the peak already. So question, can we still get high quality income assets? Can we still get high quality assets at attractive yields? Yes, we can. So today I'm going to show you where, okay, and what I've been actually buying. Okay. Now, before that, let me teach you some important principles in buying dividend or income assets, right? Now, most people, when they buy a dividend stock or dividend asset, what's the first thing they look at? What's the first thing they look at to check whether it's attractive? They look at the yield. What's my dividend yield, right? Okay, that's the first thing they look at. But is it the most important thing? Is it the most important thing? No, it is not the most important thing. Okay, so let me give you an example over here. Let me go to Stock Oracle, okay, and let me put in. Let me show you an example. So far, is this useful? The information, guys? Are you following? Okay, great. So let's look at a stock, for example, a potential dividend stock. Okay. So this stock is called Two Harbors Investment Corporation, ticker symbol TWO, and this is actually a REIT, right? It's actually a REIT listed in the US. Now, what is the dividend yield? What is the dividend yield? The dividend yield is 15.96%. Now, at first glance, does this look attractive? Does this look attractive? 15.96% yield. Yes, it looks, wow, very attractive, right? Okay. Now, again, it's the first thing we look at, but it's not the most important thing. Okay. Now, first of all, just to make sure that you guys understand this, how do we calculate the dividend yield? The dividend yield is the dividends per share that you get a year divided by the share price, right? So let's say, for example, this share is selling at $10. Okay. Let's say $100, because it's $100, right? And every year, the last 12 months, they pay $5 in dividends. Okay, they pay $5 in dividends. What is the yield? The yield is 5%. So far, you understand? Okay. Now, so a lot of people, they look at the yield and they think the higher the yield, the better, right? Now, one of the most common mistakes that people make, listen carefully, please write this down. The most common mistake people make is they buy stocks with high yield, but the dividends that are paid is dropping. So is it possible that this stock pays less dividends every year? The dividends are dropping, but the yield remains very high. The yield remains very high. Is that possible? How is that possible? They are paying less dividends. This is dropping. So how come this can be high? Because the share price drops even more. You understand? So the most important thing is to make sure that whatever you're buying, the company has a track record of what? Of increasing the dividend per share for the last 5 to 10 years. Is that clear? That is the most important thing I look at. The company must be increasing the dividends per share in the last 5 years at least, or 10 years better. Yeah? So if we take a look at this example here, you can see that the yield is 15.96%, but look at the dividends growth. Okay, so if you scroll down here, this is Stock Oracle, by the way. You might scroll down here. Okay, now take a look at this. Okay, so the dividend yield, okay, is here 16%, right? But look at the dividend growth rate. In the last 3 years, the dividends have been declining 12% a year. In the last 5 years, the dividends are declining 23% a year. The last 10 years, the dividends are dropping 14% a year. So this is a lousy investment. You understand? Because they are paying less dividends every year for the last 3, 5, 10 years. Is that clear, guys? Okay, so this cannot be negative. This cannot be negative. This must be positive. Okay, the dividend growth rate must be positive. And if you want to see the actual dividends, let me go to company metrics. There. So can you see the dividends per share here? Look at the dividends per share. Can you see it's declining? Can you see that? Can you see it's declining? All right. So at first they pay 2.72, then they pay 2.64, then they pay 1.95, then they pay 1.8, then they pay 1.63, right? So they keep paying less and less dividends every year. And because they pay less and less dividends every year, what happened to the share price? What happened to the share price? What happened to the share price? The share price is falling, right? So when you buy the stock, not only do you get less dividends, but the price keeps dropping. You die both ways, right? How many of you have made this mistake before? You bought the stock because all the yield is so good, everybody the share price kept dropping, and you get less and less dividends. Any of you experience that? So this is the most common mistake that people make, okay? Now, so key lesson number one, please write this down. First lesson today, you got to pick stocks with both attractive dividend yield and dividend per share growth. Now, what is an attractive dividend yield? What is considered attractive? What is considered attractive? It depends on the prevailing interest rate, okay? So for the current situation, to me, attractive dividend yield is at least 5%. At least 5% a year. Less than 5%, I'm not that interested, right? At least 5%. And the dividends must be growing. The dividends must be growing, okay? Is that clear, everyone? Dividends must be growing, yeah? So let me give you some more examples. Let's look at, okay, I did a screenshot here anyway. Yeah, I'll show you the Singapore banks later, right? So just hold on first, okay? Now, if you look at this stock, which is Helmerich and Payne, right? If you see the word pain, you should not buy because you get a lot of pain already, see? So if you look at this stock, again, what is the dividend yield? Okay, the dividend yield is 3.63%. Is that attractive? Is that attractive? No. And look at the dividend growth rate. The dividend growth rate for the last 3, 5, and 10 years, it is what? Negative, negative, negative. So this sucks, right? This totally sucks. Now, if you look at this stock, CME Group, what's the dividend yield? The dividend yield is 3.86%. Okay. Now, like I told you, these are US stocks. US stocks, even the highest yield you can get for good companies is about 3%. There's no way you can get 5% in your dreams. In your dreams, okay? You can only get 5, 6% outside the US. US, you can only get 3%. Okay? But at least the dividends are growing. Can you see the dividends are growing? In the last 3 years, the dividends grow 14% a year. In the last 10 years, the dividends grow 10% a year. Can you see that? So let me tell you the danger with stocks that you high yield but negative dividend growth. Okay. So everyone can see this table in front? Can anyone see this table in front? Okay, cool. So let's say this is the year you buy the stock. You buy the stock at $50 and they currently pay a dividend of $3.50. Okay. So what is your current dividend yield? Your current dividend yield is $3.50 divided by $50, which is 7%. What is the cost price that you pay for the stock? You pay $50, right? So your yield on cost is also 7%. It's also $3.50 divided by 50 is also 7%. Now, once you buy this lousy company, right? As the years pass, what happened to the dividends? What is happening to the dividends? What is happening? The dividends is declining at 11% a year, right? So you're getting less dividends every year. Can you see that? And a company that gives less dividends every year, what happens to their share price? Their share price also keeps dropping. Can you see that? It keeps dropping, keeps dropping, keeps dropping. But because the dividends drop and the share price drops, the yield remains high. Can you see the yield remains high? Because 1.95 divided by 28 is 7%. 2.2 divided by 31.5 is 7%. You follow what I'm saying? But notice that your yield on cost, see, you have to calculate your own yield on cost. So in year one, what happens? You are now getting less dividends, right? You're only getting $3.12, but you paid $50. So $3.12 divided by $50, your yield on cost is 6.2. And then in year 5, you're getting $1.95, but you paid $50. So $1.95 divided by 50, your yield on cost is 3.9. So your yield on cost is declining. Can you see that? So that's the danger with buying a stock with high yield, but negative dividends per share growth. Okay? Now, if you look at CME Group, let's look at CME Group. Here, let me put it in. Yield on cost, like I explained, okay? Someone asked what's yield on cost again, okay? So yield on cost, like I explained, is the dividend that you get divided by your cost price that you bought it at. You understand? Okay? So let's look at CME Group. So if you look at CME Group, what is the dividend yield right now? The dividend is 3.81%. Okay, now the starting yield doesn't look very high because I said I want at least 5%, but for a US stock, it's very good. For a US stock, it's very good because US stocks are usually about 3%. So this is very good for a US stock, okay? And let's look at the growth rate. The growth rate is double-digit growth rate. Can you see that? It's a double-digit growth rate here, okay? So although the starting yield may not look very attractive, but because the dividends are growing at double-digit, what's going to happen? Very soon, your yield on cost will be very attractive. So let me show you, Okay, but before that, a lot of you have been asking me about DBS, UOB. Okay, so let me show you. Now, why I love the Singapore banks. Okay, by the way, I love the Singapore banks because in the long run, they have got the most consistent dividend growth. Okay, they've got the most consistent dividend growth. So you look at DBS. Okay, DBS right now, what is the starting yield? The starting yield is 5.28%. So, okay, by the way, this was taken a few weeks ago. Right now, it has dropped below 5% already, if I'm not wrong. Later, I'll show you the latest. But at the time I took this, DBS starting yield was 5.28%. Now, is that attractive? Yes, right? More than 5%, right? But what is even better is look at the dividend growth rate for DBS. You can see that the growth rate in the last 5 years is 12.9%. In the last 10 years, is 14% a year. That means, think about it, in the last 10 years, DBS increased their dividends 14% a year on average. Is that good? That is damn good. That's damn good. Okay? So that's why DBS is my biggest position in my dividend portfolio. DBS alone, I've got more than $1 million invested in DBS. Of course, I didn't invest $1 million. I invested much less, but it has grown to more than $1 million right now. okay, because of the compounding effect, right? So let me show you what happens, okay? So let's say you have a company like DBS. Okay, now by the way, when I bought DBS at the time, the yield was 6%. Okay, now it's 5%, but it's less, but it's still not too bad, right? Okay. And again, DBS, the dividends grow about 12 to 14% a year, but let's take 12% as a conservative number moving forward, okay? So in the first year, let's say, example, I buy this stock at $50 and they pay $3 dividend, okay? So 3 divided by 50, dividend yield 6%, yield on my cost price also 6%, okay? Now, over time, what happens to the dividends? What happens to the dividends of a good company like DBS or UOB or OCBC? All three of them are good companies. What happens over time? You get more dividend per share, right? Okay. And companies that pay more dividends every year, will the share price also go up? Yeah, the share price will also go up. Okay. So because the share price goes up, the dividends go up. What happens? The yield will remain the same or even fall. Correct. But look at your yield on cost. What happens after 1 year? After 1 year, you are getting more dividends. $3.36, but you paid $50. So 336 divided by 50, your yield on cost is now 6.7%. Can you see that, guys? By the 5th year, you're getting $5.29 dividends, but you only paid $50. So 529 divided by 50, your yield on cost is 10.6%. So can you see that when you buy a stock where the dividends are growing, your yield on cost will keep growing? Can you see that? So this is what I look for. This is what I look for in my dividend portfolio. Okay. So this is my screenshot I sent to my students. Again, those of you who are subscribed to the UIP, as you guys know, you get to watch my portfolio. I do a deep dive on my portfolio every month. You can see exactly what I own and the allocation. And every day, whatever I buy and sell, I'll do a screenshot and you get notified immediately once I buy and sell something. So you can see that during the COVID, in 2020 COVID, I bought DBS at $18.66. And then I bought at 18. So I kept buying at about $18. Okay. So my cost price for DBS was $18. Okay. Now that time, DBS was paying a dividend of 93 cents during the COVID. So my starting yield was 5%. From 2020 to today, DBS has increased their dividends, and this year, their dividends from 93 cents, they have increased it to $2.40. So for my initial purchase of DBS, what's my yield on cost? I'm getting $2.40 divided by 1856. So my yield on cost is 12.9%. Can you see that? So when I tell people that my DBS are getting 13% yield, they say, how can you get 13%? I say, because I bought it last time, and then my yield on cost is going up. Okay? So this year, DBS alone, I collected close to 50, 60,000 just on dividends. And it will keep increasing at 12, 14% every year. Hopefully, I mean, there's 100%, hopefully, right? Yeah. Okay. So what I've shown you are dividend stocks. Okay, what I show you are dividend stocks. Okay, dividend stocks, the starting yield is 3 to 6%, right? It's 3 to 6%. Okay, by the way, before that, some of you are asking me right now, would I buy DBS right now? The answer is no, I won't. Okay, why? Because right now DBS is currently a bit overpriced, right? In fact, let me just check what is the latest yield. Now, Stock Oracle currently only has US listed stocks. Next year, we will be putting Singapore, Hong Kong, and China listed stocks. But now it's only US listed stocks. So can you see DBS Bank on Stock Oracle? Yes, you can. But you can only see the US listed version. Okay, you can only see the US listed version, which is in US dollars. Okay. So you can see the intrinsic value is about $30 US. Right now it's 43 US, right? So now it's currently a bit overpriced. It's a bit overpriced. And currently the yield, now the yield has dropped. It's dropped about 4%, right? Dropped 4%. So right now it's not that attractive. Okay. So that's why I've not been buying DBS this year. No, I did buy a bit in April when it dropped. Let me show you. Let's go DBS. Okay. So you can see that for the banks, okay, there we are. Okay, so let me show you what all this means. Again, all this you will learn in the course, and in UIP, if you're subscribed to UIP, I draw all this for you, right? I do all the research and I update the buy levels, I update the intrinsic value every month, right? So that you save a lot of time. I do everything for you basically, right? Okay, so if you look at DBS, right now the share price is $54. Okay, $54. Now, can you see this thing called the 5% yield line? The 5% yield line is $48. So what does this mean? This means that DBS has to drop to $48, then you get a 5% yield. So right now at 54, you're getting less than 5%. So for me, like I told you, I want to get at least 5%, right? So for me to be interested, it's got to drop below $48, so I get at least 5%. Now, if you value the bank using a average price to book ratio, you can see the fair value is actually $33. So right now, DBS is quite far above the intrinsic value. But for Singapore banks, I'm not so strict that I must buy below the intrinsic value. I'm not so strict. As long as I get 5% and it's within one standard deviation of my fair value, I'm willing to buy. So I can tell you, for me personally, again, this is not a recommendation for you to buy. All these stocks I talk about, I'm not recommending you buy. I only tell you that I bought, and I'm just sharing why I bought for education purposes. But whether you should buy or not depends on your own investment objectives. Okay, so I make it. I'm not here to tell you to buy. Okay, this is not a recommendation. Huh? But for me, I'll only be attracted to buy at $40 or lower. Why? Because at $40, I'm getting more than 5% yield, and it's within the one standard deviation fair value range. Okay, now you can see that in April, during the trade, the tariff, right, the Trump tariff, when DBS dropped here, I bought here because it dropped within my buy. This is my buy zone. You see, it must drop in my buy zone, then I'll buy. I'm very, very strict. Okay. For OCBC, my buy zone is again, within the one standard deviation range, right? So my buy zone is within this range. So right now it's out of my range. So like you can see for me, I'll only buy below 1620. And only there will I get more than 5%. Okay. So again, all these lines I update every month for my subscribers. So they just have to look at it. Okay. UOB, okay, is the only one that is within the buy zone. So you can see UOB is below the 5% yield line. So you're getting more than 5% yield and it's within the one standard deviation. Okay. It's within the one standard deviation. So it is within the buy zone over here. It's the only one within the buy zone right now. Right. So yeah, just to check it. Okay, I know you guys have a lot of questions, and again, I'll do my best to answer them in the Q&A session. But right now, let me run through the slides first. If not, I can't finish. Yeah. So far, is that cool, guys? Is it useful? Would I buy UOB now? I won't mind buying. I wouldn't mind buying personally, but I'm not because I already bought quite a lot earlier in April when it was much cheaper. So I already have used up my quota this year. Right? So every year I've got a quota how much I'll buy. Once I use my quota, I won't buy anymore. Then next year, I'll wait for it to drop to my buy zone. Then I will start accumulating again. Right? Okay, so let's look at this right now. Okay, so the first thing I showed you are dividend stocks. Okay, and again, the starting yield is between 3 to 6%. If you're looking at US dividend stocks, then it's about 3%. Okay, if you look at Singapore, it's about 5 to 6%. If you're looking at Hong Kong, you're looking at the UK, then it's somewhere in the middle, right? It's somewhere in the middle. UK, Hong Kong, those are somewhere in the middle. Okay, right. Now again, in the income investor course, I'll give you the tools. I'll show you how to find again dividend stocks in the US, in Hong Kong, in UK, all around the world. Okay. But again, I'm feeling that for me personally, I tend to focus on Singapore because highest yield and no dividend tax. Okay. Next, REITs. I'll cover REITs in a while. REITs are again 5 to 7% yield. I showed you earlier on. Corporate investment grade bonds are now 4.4%. Treasury bonds, which are US government bonds, 4%. Private credit, again, 8 to 9%. That's the highest starting yield. High yield bonds, 5.77%. And income funds, we call that closed-end funds. Those are quite high as well. Right? But I'm going to focus today. I'm going to focus on private credit, okay, and REITs. Okay, I'm going to focus on these two. The rest is covered in detail in the income investor course. Yeah. Okay, so let's talk a bit about private credit. Would you be interested to learn about private credit? Okay, good. So what is private credit? Private credit is also known as direct lending, right? Direct lending. So let me give you an example. Now, when a company wants to grow, they sometimes have to borrow money to grow the company, correct? Now, how do companies borrow money? A few ways. Number one is they can issue bonds. Like Lehman Brothers, at the time, they sell bonds. Or High Flux, they sell bonds, right? SIA, they sell bonds. So when they sell bonds, they raise money. Okay, that's one way by selling bonds. But what kind of companies can sell bonds? Small companies or big companies? Can small companies sell bonds? No, right? Only big companies can sell bonds, right? Okay. So one way to sell bonds. Another way a company borrows money is they go to a bank and they borrow money from a bank, correct? That's another way, right? Now, the problem with borrowing money from a bank is that the approval process is quite long, right? It takes a few months to approve the loan, correct? And at the same time, the terms of the loan can be quite rigid, right, in terms of the interest payments and all those things, okay? Now, if you are a small to medium-sized company, okay, now small to medium-sized company in the US is between 10 to 100 million revenue, okay? This is what we call small to medium-sized companies. In the US, they call them lower middle market companies, okay? Now, for these small companies that they need to borrow money, okay, can they sell bonds? Can they sell bonds? Cannot, they're too small, right? Can they borrow money from the bank? Yes, they can. But oftentimes these companies, if they need the money fast, they need it fast. They can't borrow from the bank because the approval will take too long, right? So if they need the money fast because they need a bridging loan or they're doing an urgent acquisition, what happens? Then they won't go to the bank because the bank is very long, very flexible. So they go to private credit companies called BDCs. They say, hey, I want to take a loan and it's approved much faster with more flexible terms, right? So in other words, it's kind of like a legal loan shark. It's like a legal loan shark. And because it's very fast and it's flexible, they charge higher interest, like a legal loan shark. And the interest is a floating rate. So the higher the interest rate, the higher they charge. Okay, so that is basically private credit. Now, so SMEs borrow from private credit for the following reasons. Number one, because of flexibility and customization of certain terms. So they're more flexible with the terms of the loan. And they specialize in certain niches like distressed debt, venture debt, real estate financing, or asset-backed lending, providing capital for situations that banks normally will not want to get into, right? The speed of approvals are faster, the loans are confidential, and the companies are too small to issue bonds. Understand? So that's basically private credit. Now, some people have this misconception. They think, well, private credit is very risky because you're lending to these small companies. What if they don't pay back, right? You know, they think that bonds are safer than private credit. Is that true? Are bonds safer than private credit? Even investment grade bonds? Well, that is the misconception. That's what I used to think. But if you dig deeper, not really. So let me explain why, right? Now, the problem is when you buy bonds, even investment grade bonds like triple B and double A bonds, right? You buy bonds from, again, SIA, you buy bonds from High Flux, whatever, right? You know what's the problem with all these bonds? These bonds are not secure. None of them are secure. That means the money that you lend them, there's no collateral backing. So if the company goes bust, Lehman Brothers goes bust, High Flux goes bust, you get nothing back. You understand? So to me, even though the bonds are investment grade, but they're unsecure. There's no collateral, okay? However, private credit, when they lend to these small companies, although the companies are not investment grade, they're not big companies, but they are what? They are all secured lending. It's secured against the inventory. Actually, most of the time, they're secured against the receivables, against the inventories, and secured against the real estate. So they're all secure, okay? And for me, I only buy private credit funds where the majority of the debt is what we call first lien senior secured debt. First lien senior secured. What does first lien mean? First lien means if the company cannot pay, The private credit has got the first right to seize their property and to seize their assets. It's called first lien senior secured. Okay, it's the type of debt that's got the highest priority claim on the borrower's assets. In the event of default, the lender holding this debt has the first right to seize and sell their assets to recover their investments. And the collateral which they lock in is much more than how much they lend the borrower. So if the borrower cannot pay, no problem. Take the asset, liquidate, you get more than the money back. All right, understand? So that's called private credit. So again, for private credit, how is it different? Okay, how is private credit different from public credit? Public credit are basically bonds. Okay, these are bonds that can be traded. Okay, in the secondary market, right? So bonds are typically publicly tradable. You can trade bonds. Private credit are typically illiquid and untradable. Okay, public credit is determined by ratings agencies where they rate the bonds, right? Is it triple B, double B, 1B, triple A, double A, and it makes them look safe, but they're unsecured. Private credit is unrated, but they are secure. Okay. Now take a look at this chart over here, and you can see this is the return. Okay, the return and the volatility. Now, if you look at private credit gives the what? Highest returns with the lowest volatility. Okay, whereas investment grade bonds, if you buy corporate bonds, you can see that it's got lower return and much higher volatility. If you buy high yield bonds, yes, the returns are high as well, but the volatility is very high. So private credit in a way is the best of both worlds. High returns, but low volatility. Okay. Now again, the disclaimer is I only look at what? High quality private credit. The best of the best. I only buy the best. Okay. The highest quality, which is the top 1% or less, right? The 99% I don't touch. So again, you have to know how to pick the good ones. Okay. Again, same thing. Are REITs safe to invest in? 99% no. Only the top 1% yes. Same thing private credit. 99% not safe, 1% safe. So the key is you have to buy the 1%. Same thing when you invest in growth stocks, which I taught you in the first one. 99% of growth stocks are not safe. They may go up in the short term, but they will drop eventually and never come back. But it's the top 1% that will go up consistently. Is that clear, guys? So how do you define top quality, right? So as you guys know, I've got certain criteria to select the high quality. Okay. So let me give you some of my criteria. Oh, so before that, let me explain a bit more. Okay. So how does someone invest in private credit? We invest through a BDC. BDC is called a business development company. A BDC is a closed-end investment company that makes loans to SMEs and also invest in the equity of the SMEs once in a while, right? That's called private equity. So these BDCs, basically about 90% are lending money to companies and 10% is they also invest in companies. So it's 90% private credit, 10% private equity, okay? Now, by law, like REITs, 90% of the income of a BDC must be paid out to investors every year, just like REITs, okay? And a BDC is not taxed at the corporate level. They have no corporate tax. But to get no corporate tax, they have to pay out 90% of all their profits, just like a REIT, okay? And again, their starting yield is between 8 to 10%. Now, so how do you buy BDCs? There are two kinds of BDCs. So far, you guys follow me? Okay. So there are two kinds of BDCs. First are those listed on the stock market. We call them listed BDCs, okay? Then you've got non-listed or semi-liquid BDCs. These ones are not listed on the stock market. You can only buy through private bank or buy through Endowus private wealth management, okay? Now, this one, okay, this one on the right, they are only for accredited investors. So accredited investor basically means that you're someone who has at least $1 million of liquid assets, excluding your property, and you earn at least $300,000 a year, okay? So it's only for accredited investors, and you can only subscribe once a month, and redemption is quarterly. So in other words, you can't buy and sell that fast. Okay, you can only buy once a month, and if you want to redeem your money back, it's only once a quarter, and there's a limit to how much you can redeem. Okay, and usually the minimum investment is 50 to 100K, and the price is always at the net asset value. But because it's not listed on the market, the price is less volatile, and there's no withholding tax. Okay, so that is the non-listed one. Now, for retail investors, they can buy the listed BDCs, and you buy and sell it like any stock, no difference. Minimum you can buy one share or buy fractional shares through interactive brokers. Okay, but because it's listed, the price can trade above or below the net asset value. So ideally, if the price goes below the net asset value, then it's then cheap. Then that's the time I would buy a lot, which is what happened a few weeks ago, right? Now it's near the NAV. Okay, so it's still attractive, right? Now because it's listed, it's more volatile. Okay, it's more volatile. But this one has withholding tax, 30% withholding tax. Okay, so which one do I own? Do I own the listed one or the non-listed one? The answer is I buy both. In fact, I've got equal amounts. Why? Because they both have their pros and cons. So why do I buy some of the non-listed ones? Why? Because I don't pay any withholding tax. So in other words, I get the full 9 to 10% yield. Okay, without paying withholding tax. But the catch is that I can't buy and sell it that easily because it's not listed. Okay? It's semi-liquid. Understand? Now, the other half of my BDCs, I buy the liquid listed one. Why? Because I can sell and fast. If I need the money, I can get out fast. Okay, but there's a 30% withholding tax. So because there's a 30% withholding tax, I will only buy this one when they are very attractive, when the yield is 10 to 13%. Why? Because if I get 10 to 13% and I deduct the tax, I still get what? I still get 7 to 9%, even after 30% withholding tax. So it's still quite attractive. You follow what I'm saying? Clear? Okay, so again, this is not a recommendation for you to buy. Let me make it very clear. This is shared for educational purposes. Before you invest, please consult a financial advisor and do your research, okay? I'm not asking you to buy this. I'm just telling you that I bought and I'm explaining why I bought, okay? Now, in the US market, there are only 50 listed BDCs. There are only 50 listed BDCs. There are only 50 of them, right? And out of 50 of them, I would only say about 5 are high quality. Only 5 are high quality. The other 45, I won't touch them. Okay, I won't touch them, right? The only 5 I would touch because I think they are the high quality ones. So would you like to know some of them? Okay, again, I'm not telling you to buy. Adam is not recommending to buy. Adam is just telling you why I think it's high quality. Okay, so first of all, how do I know it's high quality? I've got a set of selection criteria. Okay, I can't go through all because I don't have time. I've only got 3 hours today. I'm talking very fast. I'm trying to teach as much as I can, but there's only so much I can cram in 3 hours. Okay, that's why I created the income investor course where everything is covered in detail. Okay, so let me share with you some of the things I look at. Number one, when I buy a private credit BDC, I'm looking at a dividend yield of at least 8%, at least minimum 8%. Okay. Number two, I want to make sure that the dividends per share is growing. If it's not growing, at least it is stable for the last 5 to 10 years. Okay. Number three, the book value per share, also known as the NAV per share, must be rising. The net asset value must be rising for the last 5 to 10 years. Okay. Next, I want to make sure that the BDC has low credit risk. Now, again, let me ask you this question. When a BDC lends money, do you think 100% they get paid back? Do you think there'll be some bad debt where some companies can't pay the money back? Is that possible? Of course that will happen, right? So you want to make sure that the company has a track record of having very low bad debt. Okay, so how do I know? A few things I look at. Number one, I want to make sure that the majority of their loans are senior secured loans. At least 80% are senior secured loans. So in the event of default, they are the first to claim the collateral and get their money back. Okay. Next, I want to make sure the non-accrual rates are below 3%. What is the meaning of non-accrual rate? When a BDC lends money to a company, the company pays interest, right? As well as the principal back. Now, if they don't pay interest, after 90 days, what happens? After 90 days, they don't pay the interest, what happens? These are called non-performing loans, or they're called non-accrual. That means they're not getting paid back, right? Now, it will happen, of course. We want to make sure that it's less than 3% are non-accrual. That is very safe, okay? And of course, some of them eventually may become a bad debt and they can't get their money back, right? That is called the loss rate. So to make sure the annual loss rate is below 2%. Now, very few BDCs can do this. That's why I only invest in those very safe ones, okay? And when a BDC lends money, they lend to hundreds and hundreds of companies so that no single investment should dominate the portfolio, right? No one borrower should be more than 5% of the assets. So I'm going to give you one case study. Again, this is not a recommendation to buy. It's just a case study, and I bought this as well. And I bought this one called Blackstone Secured Lending Fund. Okay? Blackstone Secured Lending Fund. And who has heard of Blackstone, by the way? Who's heard of Blackstone? Blackstone is one of the biggest private equity and private credit companies in the world. Okay? Now, this BDC that they launched is quite recent. It's only about 3 years, right? It's only 3 years. But I told you I look for at least 5 years, right? But the reason I was willing to buy this is because Blackstone is one of the most reputable. So because of the track record of the company, I was willing to buy it. And so far, it's done pretty well. So I'm quite happy. Okay. So if you look at this Blackstone Secured Lending Fund, you can buy it on the stock market under BXSL. Okay, BXSL. Currently, the dividend yield is 10.3%, which is not too bad, right? It's above 8%, right? Is that? Okay. And if you read the fact sheet, I'll show you a few facts on what I look at. Okay. So you can see that 98.2% of their loans are first lien senior secured. So is it majority? Is it a majority? Yes. Okay. And I told you that the non-accrual rate should be less than 3%. What is their non-accrual rate? Their non-accrual is only 0.3%. Does it look quite safe to me? Yeah. And they lend to 295 companies. Average loan to valuation ratio 46.9%. Okay. 98% of their loans are floating rate. Okay. What else do I look at? Yeah. The net asset value per share, right? You can see that it is quite consistent, right? The NAV per share, can you see? If you add the cumulative dividends, right, you can see it's growing. Okay. And the dividends per share, okay, the dividends per share, right? You can see it's quite consistent, right? So these are the things I look at. And this is the dividend yield. You can see the dividend yield here. It's about 10, 11%, 10, 11%, right? So let me show you what it looks like on the chart. BXSL. Okay, so this was only listed recently. Okay, only listed recently. Now, when you're looking at the chart of dividend stocks and BDC, you need to adjust for dividends. Can you see here, adjust for dividends below here? Because you need to include the dividends because a lot of the returns come from dividends. So include dividends here, all right? And if you look at the return, okay, since the IPO to now, all right? And if you compare it to the S&P 500, now, of course, you can't really compare because S&P is more for growth. This is more for dividends, right? But if you compare to the S&P 500, you can see that if you include the dividends, it is in fact quite on par with the S&P 500. Is it? It's quite on par with the S&P 500. Okay. What's the minimum to invest? Okay. So what's the share price right now? The share price right now is $27.59. So what's the minimum number of shares? Minimum is 1 share, right? So minimum investment is $27.59. Minimum, right? Of course, with certain brokers, you can also buy fractional shares. So you can buy less than $25 if you want, right? So that's one example. Another example is Ares Capital Corp. And again, these are all listed BDCs. These are all listed. So any retail investor can buy it on the stock market. So this one, Ares, again, I won't go into detail, but it's one of the top ones that I have looked at. Ticker symbol ARCC. Okay. And this one has been around since 2004. Can you see? Since 2004. So it survived the great financial crisis. It survived the COVID. It survived many recessions. And if you compare it with the S&P 500, let me compare with the S&P 500 for the long term, you can see that if you include the dividends, this BDC, okay, ARCC, this BDC, even outperformed the S&P 500 and is giving a dividend yield of 9 to 10% a year, plus beating the S&P. Is that not too bad? Not bad, right? Okay. So BDCs can be quite good, right? If you pick the good BDCs, okay? So that's ARCC, okay, which I showed you, and the BXSL, okay? Okay, good. So I've talked about private credit. Again, there's a lot more to learn. What I'm sharing with you now is like the tip of the iceberg, the scratching the surface, because in the income investor course, I'll spend a lot more time going into detail into the BDCs, into private credit, how to analyze, and stuff like that. But I'm just sharing with you an idea of what it's all about, right? To give you an idea, okay? Now, next, let's talk about REITs, real estate investment trusts. And again, you've got US listed REITs, Singapore listed REITs, Hong Kong listed REITs, Malaysia listed REITs, right? Many REITs, right? So one thing is Singapore is one of the biggest REIT markets in the world. And if you look at this chart, again, this is the dividend yield versus the volatility. And you can see that Singapore REITs, which are here, this Singapore REITs, right? Singapore REITs have one of the highest dividend yields. And I wouldn't say the lowest, but it's got a pretty good risk-adjusted return here, okay? If you buy a Hang Seng REIT, Hong Kong REIT, yes, right now Hong Kong REITs have got higher yield, okay? But it's also got higher volatility. Can you see that? US REITs here have lower yield, plus you got 30% tax on this one, and higher volatility. Can you see that? So Singapore is the sweet spot. High yield, low volatility, and no tax. Right, and the total return of these dividend stocks is roughly equal to the S&P. Why not simply invest in the S&P? Because remember, when you buy the S&P, it is for capital gain, right? But when you buy the dividend stocks, you're getting cash. You're getting cash payout every month, every quarter, right? So it depends on your objective. If your objective is to grow your wealth, then you buy US stocks, which is my first webinar. But if you want a portfolio where you get cash regularly, then you look at dividend stocks and REITs and private credit. So it depends on your objectives, okay? Different objectives. Okay, so let's talk about REITs. So what's a REIT? What's a REIT? A REIT is a collective investment scheme where this trust raises money from shareholders to purchase and operate income-generating real estate assets like shopping malls, hotels, office buildings, hospitals, and industrial parks. And by law, 90% of the income collected by the REIT, they have to pay back to shareholders as dividends every quarter. So these are all the different types of REITs. As you guys know, you have got office REITs, you've got retail REITs, industrial REITs, data center REITs, healthcare REITs, residential REITs, and hospitality REITs. And diversified REITs, where a diversified REIT has a mixture of, let's say, retail and office, or a mixture of data center and industrial, right? So out of all these, okay, they all have their pros and cons, okay? But I can tell you the one that I don't like out of all this. Can you guess which one I tend to avoid? Which is the one that I will always avoid? Which type of REIT will I always avoid? This one. Avoid office REITs. Why? Because office REITs are very cyclical, okay, and they have got the least differentiation, right? So they don't have much pricing power, okay? However, there are certain high-quality REITs like CapitaLand Integrated Commercial Trust, where they've got a combination of high-quality office and retail that balances it, right? So that's fine. But if it's a pure office REIT, I would avoid it personally, okay? But if it's a diversified and has some retail, some office, okay, because the retail would make it more defensive, if you will. So this shows you the average yield that you'll get right now, right? So hospitality, okay. By the way, I also don't like hospitality. Okay, I don't like hospitality and I don't like office. These two I don't like them. Why I don't like? Because they are more cyclical. They are more sensitive to the economic cycle. Okay, so industrial REITs I like. That's 6.1% right now in Singapore. Retail REITs I like 5.8%. Very defensive. Retail REITs in Singapore very defensive. Diversified REITs, yeah, I like. Healthcare, there's only one good one, which is Parkway Life REIT. But that has got the lowest yield, but it's the most defensive. It is the most recession proof. Okay. So again, like in Singapore, you have got many REITs. Okay, and out of all the REITs, I would say that only a handful are high quality. So what do I look for? I'll show you an overview, but then again, we'll go through the details in the income investor course because that will take many hours. Okay, but I'll give you what I look for. So when I buy a REIT, what do I look for? The first thing I look at is the property yield. Okay, now this is different from dividend yield. Property yield is different from dividend yield. Property yield is the net property income divided by the market value of the properties. Okay, so I want it to be ideally 4 to 5%. Ideally 4 to 5%. This is similar to what they call the cap rate. Okay, they call it the cap rate, right? Next, number 2, I want to make sure that the REIT has a history of consistently growing revenue, net property income, and distributions per unit, which is the dividends. Okay. Now, how many of you, however, realize that COVID temporarily affected the revenue and the dividends of some very good REITs? Like for example, one of my favorite REITs is Fraser Centrepoint Trust. Okay, so Fraser Centrepoint Trust, they only focus on Singapore suburban malls. So a lot of the suburban malls in Singapore, they are all owned by Fraser Centrepoint Trust. And to me, it's a very defensive REIT. Why is it defensive? Because if you go to the mall, it's always packed, right? It's always fully tenanted, okay? And because they're in the heartlands, all right, you find that you always get a stream of people. So even if the Johor Causeway open, people are afraid that people go to Johor and buy things. You think people go to Johor every day? No, right? So these heartland malls will still do well. I don't have much concern about that. Now, however, in Fraser Centrepoint Trust, their revenue and their dividends have been very consistent every year. But what happened in COVID? COVID, as you know, was an artificial lockdown. And at the time, they closed the malls, and what happened? They gave the tenants the rental relief, correct? And what happened at the time? Obviously, the revenue and the income and the dividends dropped because of that. Okay, and that kind of like distorted their 5-year track record. Now, but is COVID something that is recurring? Will it happen consistently, or is it like once in a long time? Well, I hope it's once in a long time, right? We hope, right? We never know, right? But it's a one-off event. So if it's a one-off event, I ignore the COVID period, and if you ignore that, the growth is very consistent. And of course, post-COVID in 2022, we had the very high interest rate to kill inflation. That is also kind of like an exceptional event. So because of COVID and the high interest rates, a lot of good REITs, their revenue and DPUs got distorted and dropped. So I would, in a way, ignore that. You get the point? So out of that period, it should be growing consistently. That's what I'm talking about. Yeah? Okay. Next thing I look at is conservative debt. So we look at this thing called gearing ratio. Gearing ratio is the debt divided by the assets. Now, must you calculate all this yourself? Must you calculate all these ratios yourself? No, you can find it all on the REIT quarterly and annual report. And later I'm going to show you that as our student, you get our REIT screener where everything is there on one page. I'll show you in a while, okay? How we can get all these things on one page. Yeah. Next, high interest coverage ratio of 3 to 5 times. The cost of debt must be less than the property yield. Majority of loans on fixed interest, loan maturities well spread out, and rising NAV per share. Okay. So these are the criteria to make sure that the REIT is high quality. Okay. Next, once I know it's high quality, I want to make sure that it's at a reasonable valuation to make sure I get at least a dividend yield of 5%, right? At least 5%. Okay. Price to NAV ratio less than a 5-year average. REIT has stable price trend and retrace to support. And I look at all these other factors as well. Does the REIT have a strong sponsor, a ready pipeline of assets? Do they have diversified number of tenants? Blah, blah, blah. Right? Now again, if you're too lazy to do all this research, what can you do? If you're too lazy to check all these things, what can you do? Subscribe to UIP, the Ultimate Investors Playbook, where Adam Khoo will do all this research for you. And you can see exactly what Adam is buying and selling, right? But if you're going to do all this yourself, no problem. In the Income Investor course, you will learn step by step how I analyze each of these metrics and where to get all this data, right? Now, when you enroll in the Income Investor course, you will get access to this REIT screener. Let me show you. This is our proprietary REIT screener. We have got all the REITs for Singapore. All right, it's only for Singapore, by the way, this REIT screener. Okay, and straight away you can see all the ratios I talked about. Can you see the dividend yield, property yield, cost of debt, gearing ratio, interest coverage ratio, everything is there into one page. So, for example, let's look at CapitaLand Integrated Commercial Trust. This is one of the high quality ones that I invested in. Okay, and you can see what is the current yield right now. The current yield is 4.7%. So, is it attractive? Is it attractive? Price? No, right? Because it's under 5%, right? So I bought it when it was more than 5%, but now the share price went up, so it's below 5. So I won't buy now. I'll wait for it to get back above 5%, then I'll add more, right? Now the property yield is 4.7%. The cost of debt is 3.3%. So is the property yield more than the cost of debt? Yes or no? Is the property yield more than the cost of debt? Yes. Okay. So ideally we want to ensure we get that as well. What's the gearing ratio? Gearing ratio is the total debt divided by total assets. We want this to be ideally 40% or less. Ideally 40% or less. 39% is pretty safe. Okay. Then what else? I want to make sure that the net asset value is increasing, right? So ideally we want this to be positive, right? So it's increasing at 1% for the last 5 years. The dividends increasing as well. Okay. So you can see the last 1 year, 3 years, 5 years, the dividends are increasing, right? So this REIT screener, can help you to check all the REITs in the Singapore market. Okay. So you get access to this REIT screener. Nice. No, this is not available. By the way, UIP is not a course. UIP is a subscription where I basically do all the research, right? But this is the Income Investor course, right? If you're with UIP, you don't need this. If you're UIP, you don't need this. Because UIP, I do all the research for you already. You don't have to do your own research anymore. Right? You just read my research basically. Okay. So if you look at Capital VC REIT, it's one of the high quality REITs, as you can see. Right now, but right now it's not cheap anymore. Right now it's a bit, let's look at a few of them, right? So if you look at, give me a second here. Again, I own quite a bit of this in full transparency. I own all these REITs. And you can see that right now the REITs are beginning to rebound because interest rates are going down. So Capital VC REIT right now, you can see that the fair value of the REIT is 241. So it is undervalued. It is selling below the intrinsic value. Okay, it is selling below the intrinsic value, but the yield is less than 5%. You can see the 5% yield line is at 209. So now you're getting less than 5%. You're getting like 4 point something %, right? Okay. So ideally, you can see when you drop here, I bought here, right? So ideally, if you can drop nearer here, I'll add here. Right now, it's not as attractive. Okay. If you look at Fraser's Center Point, recently it dropped, but I think it went back up again. Okay, I keep forgetting the J69, you're correct. Okay, so look at Fraser's, you can see that you're getting more than 5% yield line, and the fair value is 229. So yeah, this was a very good buy level here, 233. Okay, but it's still within my buy zone, right? Because it's below the fair value, and it's below the 5% yield line, so it's still within my buy zone here, right? So notice that for every stock, every REIT, I have got all these buy zones that I mark out, so I don't have to guess, right? Once it hit my buy zone and I want to increase my allocation, I'll just add it in. Okay. Now for the Maple Tree Industrial Trust, Maple Tree Commercial Trust, Maple Tree Pan Asian Commercial Trust, and Maple Tree Logistics Trust, they are actually very high quality REITs, but they got hit recently by all kinds of things. So I wouldn't add more to them until I see their revenue, net property income, and DPU start to stabilize. It has not yet stabilized, except MPAC has really stabilized. Maple Tree Pan Asian Commercial Trust has stabilized. Maple Tree Logistics and Maple Tree Industrial has not yet stabilized. So I wouldn't add to that until I see a stabilization of those financial metrics. Okay. Again, not advice. This is I'm sharing it just for education purposes. Okay. So far has this been useful, everyone? Okay. So if you want to learn everything about all these assets, how to invest in bonds and REITs and private credit, right? There's this Income Investor course that I created. In fact, this was only created about 1 year ago, less than 1 year ago. And so these are all on-demand video tutorials. So you can watch anytime, you can watch anywhere, and you get a lifetime subscription for now, okay? Very soon there'll be an annual subscription, but for now it's a lifetime subscription if you enroll during this period. So in the Income Investor course, what would you learn in this course? First lesson is you're going to learn about how to use a portfolio of income assets to achieve financial freedom. Okay, and again, the 5 different types of cash generating assets. You learn all about dividend stocks. What is my 8-step checklist for picking quality dividend stocks? how to select the most stable stocks for attractive dividend yields, how to find dividend gems in the US, in UK, in Asia, and you can also invest in dividend ETFs. Dividend ETFs, yeah? All that will be covered here. Next, you'll learn all about investing in REITs, okay? What are the 9 REIT metrics to assess value, risk, and income reliability? What are the key growth catalysts that drive REIT value? And the 7 screening criteria to shortlist the highest quality REITs. And you also learn how to screen for the best REITs and REIT ETFs in Singapore and the US. So I'll also show you a REIT screener that you can screen for US REITs as well. As well as exit strategies, when to lock in gains at the property cycle tops and avoid risk if you want to do that. Yeah. Malaysian REITs I personally would not touch because, again, of long term, the ringgit depreciates a lot against my own currency, right? But for me, I'm happy to own US stocks because although US dollar depreciates against the Sing dollar in the long run, but the additional return I get from US stocks more than compensates on the US currency depreciation. It more than compensates, right? But for Malaysia, it doesn't compensate for the decline in the ringgit, right? Okay, next, private credit BDCs. How to lend like a bank and earn 8 to 10% yields from secured floating rate loans. Again, what is the 8-step checklist for picking top tier BDCs with solid upside potential? What are the exit strategies on when to exit when it's overvalued? What are the red flags to get out? Yeah. Then you learn all about how to invest in bonds, how to invest in corporate bonds and government bonds, how to pick the right bonds and bond ETFs based on credit rating, duration, and market cycle, how to use bond scanners to filter high yield opportunities while avoiding hidden risk. And bonds are a good way to hedge your portfolio during recessions. Like I said, in a recession, they will come eventually, I don't know when. The one thing that usually always does well in a recession are US Treasury bonds. Okay, so you're gonna learn how to buy either the individual bonds or buy a bond ETF or buy bond funds. Okay, so once you learn all these things, in lesson 6, you'll learn how to use this to plan your financial freedom journey. Okay, so how to calculate the amount of capital you need to be financially free. You learn all the financial formulas to map out your capital target, timeline, and returns. All right. So we've got a few bonuses. When you enroll in the income investor course during Black Market, you get a free lifetime access to the REIT screener, which I showed you. And bonus number 2, you get our REITs portfolio tracker as well. Right, so you can see what are the REITs that we are tracking. So again, you get a lifetime access to the income investor course. It's an on-demand course. Watch anytime, watch anywhere, just like Netflix. They're all together 6 complete lessons, 11 hours of video tutorials. You get also a lifetime access to our income investors discussion group. So there's a separate Discord chat group for the income investor course, and of course I'm there as well. We're open we're open 7 days a week, over 16 hours a day. You got questions, you can ask. I'm there. My coaches are there to help you to answer your questions, right? Because as you take the course, you're going to have a lot of questions. Okay, so the normal retail price for the income investor course is $1,899, and we're having a special discount now for Black Market. As you know, Black Market is the biggest sale of the year, so you get a super crazy discount of 65% off. So your enrollment fee is only $664.65 for this income investor course, right? Where you get again a lifetime access for now, right? In the future, when we sell it, it will no longer be lifetime. It'll be an annual subscription, but for now, it's a lifetime for now. Okay, so scan the QR code, click on the link if you want to grab this right now. Okay, and of course, if you want to subscribe to UIP or subscribe to the Whale Investor course or Stock Oracle, you can check with my team. They'll help you and give you all the information that you need, or you can just go to piranaprofits.com. You can click on our special deals for Black Market. You can see all the special packages and a la carte, and you can grab it because it's going to end really soon, right? So I'll give you a couple of minutes to enroll in this. I'm going to head to the washroom and we'll be back in less than 5 minutes to do the Q&A. So hang around for 5 minutes and wait for the Q&A. In the meantime, go grab this package, right? Oh, by the way, after this, Yuan Yi, or we affectionately call him YY, he'll be coming on. Okay. Now, give you a bit of background. YY has actually been working for my companies for over 20 years. Over 20 years, right? And for the first 12 years, guess what he was doing in my company? Any guesses what he was doing for the first 12 years? He was a mathematics teacher. So as you guys know, we have got the Adam Khoo Learning Centers last time where we teach English and math tuition. So he was a math tutor for 12 years. And what happened was that 12 years ago, he came up to me and he said, Adam, I'd like to learn how to invest. I've never invested in my life before. Can you teach me, right? So he obviously attended my investment course. He learned from Bang Fan Ban options. He learned from Alson. He learned from all of us, right? And in the last 8 years, he is, I would say, one of the top traders that I've ever taught. Okay? In fact, today, he's the only person besides me who manages my company's investment accounts. And for the last 5 to 6 years, he has generated an annual return of about 30 to 40% for my company investment account, right? Now, why I think it's great to listen to him is because, as you guys know, Alson, myself, and Bang, our accounts are several $1 million, right? Few $1 million and all that. Now, because YY started relatively later than us, we've been doing this for 20, 30 years. He only started 8 years ago. So his account is relatively small. And he only started with, I think, about 5, 10, 20,000. But he managed to 7x his account. He increased his account by 800% in 3 years. So I think there's a lot to learn from him, how he started a small account and how he grew it, and primarily using options, right? So definitely stay back, listen to him. He's coming up right after me, okay? So in the meantime, again, grab this thing, and I'll see you guys in 5 minutes for my Q&A. So, yeah, back from the short washroom break. And yeah, I can see some of you have got questions coming in. If you have questions, you can put it on the Q&A tab. And let me just do my best to answer as many as I can. Let me see, it's on my phone. So let me just share my screen first. Okay, okay, Prabhu is asking if Adam has 1 million, how would he allocate to growth, dividends, and options trading? Okay. Now I think it really depends on your age. So as you guys know, I'm not young anymore. I'm 51, right? So, at my age, I'll probably do the same as what I'm doing right now, right? Which I mentioned, right? For me, 10% I'm trading, right? And then 60% into growth, growing my wealth, and the other 30% into income. Okay. Now, as I grow older, grow older into my 60s and maybe 70s, then I'll have more of the income versus growth, right? If I'm younger, if I was in my 30s, then I'll have more growth than income. So I think it really depends on number one, how old you are, and also depends on how much quantum that you have, right? Yeah, so it depends a lot on that. There's no fixed answer. There's really no fixed answer. Like I said, for Elson and Bang, they're totally different from me. Elson is 80% into stock trading and crypto trading, and Bang is 80% into options trading, whereas I'm only 10%. So we're all different, right? Do something that you're comfortable with. And it also depends on how much time you have. If you're someone who want to spend more time in the market, then spend more time on active trading. If you're someone who doesn't like to look at the market so much, then focus more on the passive way, which is income investing. Okay. How do I determine the fair value of the banks? Okay, good question. So you will learn this in the course, right? Whether in the whale investor course or the income investor course. How we calculate the fair value of the bank is based on what we call the mean price to book ratio. The mean price to book ratio, which means you take the 10-year average price to book ratio, okay, which we actually have a calculator for that. That you will get this calculator, by the way, which I didn't mention, but you actually get this calculator. Let me see if I can find where did I put the calculator? Here it is. Okay. Yeah, this is one. So you will also get this calculator. Okay, this is called the intrinsic value calculator for banks. Okay, now for banks, the way you calculate the intrinsic value is based on what we call the price to book value. So what you need to do over here, you can see, is you have to put the price to book value for the last 10 years. So for DBS Bank, you can see 2015, 2016, 2017, 2018, 2019, 2020. You put in the price to book ratio at that year, right? 1.3, 1.2, 1.5, right? You put this all in, right? And the last financial year, and you calculate the average price to book ratio for the last 10 years is 1.42. Can you see that? So you take the average price to book ratio, which is 1.42, multiply by, multiply by the book value per share, you will get the intrinsic value, the fair value, right? And then the calculator will do a +1 and -1 standard deviation. So you know what is the buy range. Yeah? So you get this calculator and you learn how to key all this into this calculator, right? Again, if you're very lazy, I'm very lazy, do it for me. Then UIP, everything is done for you. I do all this research, I do all the calculation for you, okay? But this is the DIY thing, okay? So that answers that question. Why do we need to look at yield on cost? Because you need to know how much you're actually getting based on your investment, okay? Where can we find BDCs in Singapore? Singapore is no BDCs. BDCs are only in the US, only in the US. So again, you either buy the listed BDC, which is listed in the US market, or you buy the non-listed BDC through a private bank. You can buy on Endowus private wealth management, but you need to be an accredited investor to get access to that. Should we do DCA for dividend investment? Yes. You do dollar cost averaging, but like I teach my students, you don't do dollar cost averaging blindly. See, normal dollar cost averaging means you buy a fixed amount every 3 months or every 6 months, right? And you do it blindly. So I don't do it blindly. I look at the chart to make sure that I only buy when it is undervalued, when the price has retraced to a support level. So again, if you take a look at the chart of, let's say, UOB, okay, let's say OCBC, for example, right? And you want to do dollar cost averaging for OCBC? Okay, is it O39? Correct, O39, right? Okay, that's weird. Okay, never mind. Yeah, okay. So if you look at OCBC again, for example, right? Yeah, you want to do dollar cost averaging, but would I want to buy right here, right now? No, right? Because remember that a good stock, the price will always go up in the long run, but will it go up in a straight line? No, right? It goes through wave patterns, right? Wave up, wave down, 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 wave down, wave up, wave down, wave up, wave down, wave up. You want to buy the wave up? You want to buy the wave up? No, always wait for the wave down, then buy. Then wave up, wave down, buy, right? So always buy on the wave down, buy on the wave down, buy on the wave down, never buy on the wave up. Okay? So I don't buy blindly, I look at the wave patterns. I combine technical analysis with fundamental analysis, and that's how I get very good returns. I can beat the market consistently. What are my thoughts on REITs in niche industries that have regulatory funding to back it as well? I would be careful with REITs that get regulatory funding. I tell you why. Because it may not be sustainable in the long run. Once they lose the government funding, then their ability to sustain the dividend will drop. So I don't like that. I like REITs to be self-sufficient. Okay. Ivy's asking, are retail REITs still good? Is it e-commerce killing retail? Well, that's what they said 10 years ago. Is it happening? No. It's not happening, right? So do I buy a lot of things online? Yes. Do I still go to the mall? Yes. Why? Because in Singapore, there's nowhere else to go. Where are you going to go in Singapore on weekends? You going to climb mountain? We got no mountain, we got a hill. We go seaside. Now so crowded. Singapore, the only place to go is the mall. Okay, so no matter what e-commerce, I agree. Johor, yeah, the malls in Singapore are still packed. Okay, they're still packed. There's nowhere else, nothing else to do in Singapore. What's wrong with my mouth today? I don't know why. Okay. Maybe because I didn't sleep last night. Okay, next question. Which Fraser read did Adam talk about? Fraser Centrepoint Trust. And Fraser's Logistics and Commercial Trust, in my opinion, is also a very well-run REIT as well. Fraser's Logistics and Commercial Trust. But that they own assets in Australia and Europe, so there's a lot of volatility because it also is affected by, of course, the currency of the Australian dollar versus Sing and Euro versus Sing. But it's a pretty well-run REIT. Okay. What are the 5 support levels? What are all these levels? What is all these levels? Right? So these are all my buy levels. These are all my buy levels. So as you guys look at my calls, when I buy, I never buy at one go. I always buy over 4 to 5 tranches. Okay. So when the price waves down, I buy a bit. If it drops, I buy some more. If it drops, I buy some. So these are the levels I buy. These are my buy levels. Okay. I always average at these buy levels. Okay. What is my view on ABFSG bond ETF? I've not looked at that for some reason. Yeah, so I can't comment. But there are some good bond ETFs around and bond funds around, which in the income investing course, I will show you step by step what they are as well as how I analyze them. It's all in the income investing course. Why does DBS keep going up? Very simple. DBS keeps going up because their profits are growing at the fastest rate, as well as their dividend growth is the fastest among the 3 banks. That's the reason it keeps going up. Equity linked notes, no, I would not touch that personally. Treasury, what part of the curve? Yeah, so for me, for bonds, I tend to avoid the long end of the curve, right? Because the long end of the curve is very sensitive to interest rates. Okay, I rather, again, when I look at bond funds, I want to make sure the average duration is about 4 to 5 years of the bond funds. Okay, I avoid bond funds that go beyond 6 years average duration. Okay, then you're very sensitive to interest rates. Okay. I think a lot of companies cut dividends during the COVID. Does that impact the decision to buy the stocks for dividends? No. I tell you why. Because COVID is what we call a one-off exceptional event that is not likely to reoccur, right? So, like for example, during COVID, the 3 banks, they cut their dividends. Not because they had to cut it. They didn't have to cut it. In fact, they could pay dividends because MAS, the Monetary Authority of Singapore, wanted them to be conservative and forced them to cut their dividends. And was I concerned? No, I wasn't concerned because the banks were still doing very well, right? And in the end, when COVID was over, not only did they reinstate the dividend, but they paid more dividend to make up for the low dividend 2020, right? So you think long term, you're concerned about these short-term events, okay? Can I talk about collateralized loan obligations? I don't tend to invest in those. I don't tend to invest in CLOs. Okay. What's the difference between this course and the whale investor course? So the difference is the whale investor course is focused on capital gains. It's focused on buying companies that will compound your returns 20% or more a year. The income investing course is focused mainly on income assets like bonds, REITs, private credit, and dividends. So it's a very different focus, right? Do I buy corporate bonds of companies like Coca-Cola, blah, blah, blah? No, because the yields are so low. The yields are so low. Investment linked fund, I won't touch it personally, right? I don't think I get a very good return from that. How about fixed coupon notes? Sharon, I wouldn't touch those. I wouldn't touch those. Again, I won't go into detail, but it's something that I'll never buy personally. Okay? I don't think the risk to reward is attractive to me. What do I think of Singtel on dividend stocks? Well, I never liked it. So again, it's all about opportunity cost, right? What is Singtel's ticker symbol? Singapore Telecoms. Yeah, Z74. So if you look at the long term, let's look at the long term. Oh, recently it's gone up. Okay, so if I add the dividends, always add the dividends to see how it performed with dividends. Oh, recently it's gone up. Okay. So, well, if you compare it with, let's say compare with Capital DC REIT, okay? Because you always want to compare, right? And let's see, compare with Capital DC REIT. Which one would I rather buy? Would I rather buy Capital DC REIT or would I rather buy Singtel? Which has a higher total return? I'd rather buy Capital DC REIT. Or let's compare it with Capital Integrated Commercial Trust. What was the ticker symbol again? C38U. C38U. Okay, so if you look at the long term, you can see that, yeah, Singtel and Capital Integrated Commercial Trust, sorry, they've got the same total return over the long run. But which one do you think is more consistent? This one or this one? Which one is more consistent? CITC is more consistent, right? Yeah, so I would rather buy CICT basically. Okay, so again, like I mentioned, guys, someone's asking about Maple Tree Industrial Trust. So like I mentioned, for the Maple Tree Industrial Trust and Maple Tree Logistics Trust, historically they've been very well run, but recently their DPUs and revenue has been dropping. Maple Tree Logistics is because of problems in China that have not recovered yet, and Maple Tree Industrial is because of their US data centers that they're having some problems there. So I would say I would not add until I see that their revenue and DPUs have stabilized and start to grow again. For now, I'll just watch and I wouldn't add. Okay. All right, guys. So that's all I have for you today. Thank you for listening. And remember, YY is coming up. You've got to listen to him. He'll show you how he grew his account by 7 times in the last 3 years, and he's one of the best option traders around right now. You got to listen to him. How he trade a small account, relatively small, right, compared to us. Yeah. Okay. So see you guys, and remember to enroll in the courses while you get these great discounts for this limited period. See you then. Thank you.